As to trading strategies, there are 1,000 ways to generate consistent profits from trading. But you have to find your own way, a personalized trading system that suits your personality. The rules of your trading system will define how you interact with the market. Your entries, exits, how you manage your trades, and risk management are among the many things that should be included as part of your trading system. In this video, I will discuss the 5 elements to create a trading strategy that actually makes money. Before I jump into the first element, I would appreciate it if you could take 3 seconds of your time to like this video and subscribe to this YouTube channel. There are a ton of Forex videos on our channel which are designed to help you become a better trader. I also have a 3-day trading guide which you can download via the link in the description below. The first element involves deciding which instruments to trade. This is important because not all trading systems work on every instrument. You have to decide if you want to be a market specialist or a trade specialist. As a market specialist, you will concentrate on just one market. You might opt to just focus on the Forex market and not trade indexes or stocks. A common mistake made by a lot of traders is that they must trade every single market since more opportunities equal to more profit. This is, however, not necessarily true because, as mentioned earlier, a strategy might not work on every instrument. Many market specialists in the world are very successful. They do this by having a deep understanding of their chosen market. As a market specialist, you become familiar with your chosen market and learn the intricacies of the flow of the market. Market specialists will sometimes use multiple trading strategies to execute their trades. For example, if they see a trending scenario, they might decide to apply a trend following strategy for a swing trading setup. Conversely, if they see a ranging scenario, they might opt to use a mean reversion strategy such as the Bollinger Bands. Now, if the idea of focusing on one market doesn't appeal to you, then you can consider becoming a trade specialist. A trade specialist focuses on one specific trading setup. Whether it is a pullback setup, a breakout setup, or a momentum setup isn't that important. What is important is that you are comfortable trading the setup and can stick to it day in and day out. You gain experience in mastering that setup by backtesting and figuring out which instruments work best for that setup. To become a trade specialist, you must learn to filter out subpar trading setups. You must have a clear idea of how an A++ setup looks like. This comes from your extensive backtesting. Without putting in the work to do this, you will not gain that clarity. In essence, as a trade specialist, you need to learn how to differentiate good setups from poor setups and then manage the trade as it plays out. Choosing which time frame to trade is important, just as choosing your time frame. And that brings me to the second element, selecting a time frame to trade. To help you select the best time frame that works for you, there are 3 questions that you should consider. Number 1, what kind of person are you? Your personality plays an important part in what time frame is best for you. If you are a person who seeks quick results, then go with the shorter time frame. But if you are more of a person who wants to catch the long-term moves of the market, then go with the higher time frame. Number 2, how much time can you devote to trading? If you have a day job, it is going to be very difficult to be day trading, and thus you should be trading the higher time frame. Traders who can constantly look at the charts and have the time to analyze the market can choose to trade a lower time frame. Number 3, how patient are you? Patient traders can endure the inevitable fluctuations since price doesn't move in a single direction. Impatient traders, on the other hand, may find it hard to see through the fluctuations and thus will end up trading shorter time frames. But before you start choosing your time frame, I want to remind you that the shorter the time frame, the more time you will need to devote to trading. And because it requires intense concentration to be consistently profitable, those who trade higher time frames usually have a higher success rate than those who trade time frames such as the 15-minute time frame. The third element is your risk management strategy. What percentage of risk are you going to adopt for each trade? A good way to think about the appropriate risk for you is to set in such a way that you can sleep soundly without worrying. If you find yourself losing sleep because of your trade or constantly checking how the trade is doing, that is a sign that you are taking too big a risk. You want to be adopting a risk level that doesn't throw your state of mind off. After all, you need to be in the best state of mind possible when you are trading, not one that is anxious. The fourth element, which builds on the third element, has to do with dealing with drawdowns. While your risk management determines the size of your trade, it is also equally important that you consider and plan for your maximum drawdown. Suppose you set your risk per trade to be 1% of your equity and a maximum drawdown of 3% per week. That would mean that you can withstand 3 consecutive losing trades. Once you have hit your maximum drawdown for the week, you should stop trading and take a break. When it comes to applying this, it depends on the time frame that you decided earlier in element 2. You may opt for maximum drawdown per month if you are trading the higher time frame like the daily. If you are trading a shorter time frame like the H1, you may decide to have a maximum drawdown for the day. This is entirely up to you to decide, but do remember that your risk per trade and the maximum drawdown will affect how many trades you can take at any given time. The last element that goes into your trading strategy is trade management. Because the market never moves in a single direction, you must manage your trades. 2 things go into managing your trade: the entry and the exit. Both must be personalized based on your trading style and personality. Some traders believe that it is important to pre-plan your trades and know where your entry, stop loss, and take profit levels are when you enter a trade. This way, there is no thinking involved when it is time to enter the trade. These traders usually end up with a winner or loser, with price hitting either the take profit or stop loss level. Then you have other traders who believe that they need to actively manage their trade because they hate to see a winner turn into a loser. They might shift their stop loss to break even and trail their stop loss as price moves in their favor. Again, I will reiterate that how you apply trade management depends on your trading style and personality. You need to understand what works best for you. If you find yourself making more money when you step away and let price hit your stop loss or take profit, then you should opt for this approach. You want to choose an approach that best suits you and makes the most money. Summing up the 5 elements that go into a trading strategy, I hope that you see that a trading strategy is not just about buying or selling. It's much more than that. You have to decide what instruments you will trade, how you will trade it, and also the rules that determine when you enter or exit a trade. Drawdowns and losing streaks can better be managed with a robust trading strategy. Spending time to nail this is not the most fun aspect of trading, but it is crucial if you want to become a consistently profitable trader. Hopefully you found value from this video. As always, if you benefited from this video, please make sure to subscribe to this channel. Click the notification icon so you won't miss any of our new videos. Do leave this video a like to support this channel. Thanks for watching, and make sure you download your free day trading guide via the link in the description below.